and urban areas. Overall consumer price inflation, as measured by the 12-month change in the price index for personal consumption expenditures, is estimated to have been 1.7% in December, held down by recent declines in energy prices. Core PCE inflation, which excludes food and energy prices and tends to be a better indicator of future inflation, is estimated at 1.9%. At our January meeting, my colleagues and I generally expected economic activity to expand at a solid pace, albeit somewhat slower than in 2018, and the job market to remain strong. Recent declines in energy prices will likely push headline inflation further below the FOMC's longer-run goal of 2% for a time, but aside from those transitory effects, we expect that inflation will run close to 2%. While we view current economic conditions as healthy and the economic outlook as favorable, over the past few months we have seen some cross-currents and conflicting signals. Financial markets have become more volatile toward year-end, and financial conditions are now less supportive of growth than they were earlier last year. Growth has slowed in some major foreign economies, particularly China and Europe, and uncertainty is elevated around some unresolved government policy issues, including Brexit and ongoing trade negotiations. We will carefully monitor these issues as they evolve. In addition, our nation faces important longer-term challenges. For example, productivity growth, which is what drives rising real wages and living standards over the long term, has been low. Likewise, in contrast to 25 years ago, labor force participation among prime-age men and women is now lower in the United States than in most other advanced economies. Other longer-run trends, such as relatively stagnant incomes for many families and a lack of upward economic mobility among people with lower incomes, also remain important challenges. And it is widely agreed that the federal government debt is on an unsustainable path. As a nation, addressing these pressing issues could contribute greatly to the longer-run health and vitality of the U.S. economy. Over the second half of 2018, as the labor market kept strengthening and economic activity continued to expand strongly, the FOMC gradually moved interest rates towards levels that are more normal for a healthy economy. Specifically, at our September and December meetings, we decided to raise the target range for the federal funds rate by 1/4 percentage point at each, putting the current range at 2.25% to 2.5%. At our December meeting, we stressed that the extent and timing of any further rate increases would depend on incoming data and the evolving outlook. We also noted that we would be paying close attention to global economic and financial developments and assessing their implications for the outlook. In January, with inflation pressures muted, the FOMC determined that the cumulative effects of these developments, along with ongoing government policy uncertainty, warranted taking a patient approach with regard to future policy changes. Going forward, our policy decisions will continue to be data-dependent and will take into account new information as economic conditions and the outlook evolve. For guideposts on appropriate policy, the FOMC routinely looks at monetary policy rules that recommend a level for the federal funds rate based on measures of inflation and the cyclical position of the U.S. economy. The February Monetary Policy Report gives an update on monetary policy rules, and I continue to find these rules to be helpful benchmarks. But of course, no simple rule can adequately capture the full range of factors the committee must assess in conducting policy. We do, however, conduct monetary policy in a systematic manner to promote our longer-run goals of maximum employment and stable prices. As part of this approach, we strive to communicate clearly about our monetary policy decisions. We've also continued to gradually shrink the size of our balance sheet by reducing our holdings of Treasury and agency securities. The Federal Reserve's total assets declined about $310 billion since the middle of last year and currently stand at close to $4 trillion. Relative to their peak in 2014, banks' reserve balances within the Federal Reserve have declined by around $1.2 trillion, a drop of more than 40%. In light of the substantial progress we've made in reducing reserves, and after extensive deliberations, the committee decided at our January meeting to continue over the longer run to implement policy with our current operating procedure. That is, we will continue to use our administered rates to control the policy rate, with an ample supply of reserves so that active management of reserves is not required. Having made this decision, the committee can now evaluate the appropriate timing and approach for the end of balance sheet runoff. I would note that we're prepared to adjust any of the details for completing balance sheet normalization in light of economic and financial developments. In the longer run, the size of the balance sheet will be determined by the demand for Federal Reserve liabilities such as currency and bank reserves. The February Monetary Policy Report describes these liabilities and reviews the factors that influence their size over the longer run. I will conclude by mentioning some further progress we have made in improving transparency. Late last year, we launched 2 new publications. The first, the Financial Stability Report, shares our assessment of the resilience of the U.S. financial system, and the second, the Supervision and Regulation Report, provides information about our activities as a bank supervisor and regulator. Last month, we began conducting press conferences after every FOMC meeting instead of every other one. This change will allow me to more fully and more frequently explain the committee's thinking. Last November, we announced a plan to conduct a comprehensive review of the strategies, tools, and communications and practices we use to pursue our congressionally assigned goals. This review will include a broad outreach to a range of stakeholders across the country, and the February Monetary Policy Report provides further discussion of these initiatives. Thank you, and I'll be happy to respond to your questions.
Thank you very much, Chairman Powell. As I mentioned in my opening statement, you said that the balance sheet normalization may end sooner with a larger balance than previously anticipated, and if I understand it correctly, the ultimate size of the balance sheet will be principally driven by financial institutions' demand for reserves plus a buffer, correct?
That is correct.
Reserves have increased from $43 billion in early 2008 to about $2.8 trillion in 2014, if I understand correctly, before falling now down to about $1.6 trillion currently. Do you have an estimate of the amount of reserves that are estimated to be necessary to achieve the Fed's monetary policy objective, and how does the Fed's post-crisis regulatory policy affect this amount?
The quantity of reserves before the financial crisis, Mr. Chairman, was $20 billion in that range, plus or minus, so a relatively small amount. One of the important things we did after the financial crisis was require banking institutions, particularly the very largest ones, to hold quite large buffers of highly liquid assets. One of those assets that the banks like to hold to satisfy those requirements is bank reserves. So the demand for reserves is going to be very substantially higher than it was before the crisis and will not go back to those lower levels in any case. We only have estimates based on market intelligence and discussions with financial institutions, and those estimates have actually gone up substantially just over the course of the last year or so. We don't have a precise notion, but we believe that the public estimates that are out there of around $1 trillion plus a buffer, as you mentioned in your remarks, is a reasonable starting point, an estimate of where we might wind up.
All right, thank you. As you know, I've been a strong critic of the quantitative easing the Fed has been engaged in, and appreciate your explanation of how you intend to reach the appropriate balance of what the Fed's balance sheet should be. And I'll continue to work with you on understanding how we get to the right spot as soon as we can. You mentioned in your statement and in your report that the labor force participation rate has started to grow. That has been one of the reasons we've seen such low economic performance, in my opinion, in the past years. Do you expect that the labor force participation rate growth that we have seen will stabilize and even possibly increase as we continue to move forward?
So labor force participation, if I can provide just a little bit of background,
Sure.
was an area where the U.S. was at least comparable to other well-off countries, and in some cases at the high end as far as women labor force participation by women was concerned. We are now at the bottom end of the league table for both men and women, and it's a very troubling concern. A big part of it, though, is driven by something that we can't really change, and that is just demographics. As the country ages, labor force participation should decline at a fairly steady level. Nonetheless, even allowing for that, we're lower than we need to be. So the gains we've seen over the past year have been very positive and very welcome from our standpoint. We don't know how long they can be sustained, but we hope for a long time. I would just say that I think we need a broad policy focus on how to sustain labor force participation, including not just through Fed policy, but through legislative policy as well.
I agree. I think that that's a critical part of our ability to maintain the growth and strength of our economy. I have lots of questions for you, but just one that I'll have time for in the remaining amount of time I have, and this will get to regulatory relief and implementation of Senate Bill 2155. As you know, Senate Bill 2155 provides smaller institutions with relief from the Volcker Rule. Regardless, there are still significant issues with the rule for institutions of all sizes, and I and 6 of my banking committee colleagues wrote to our financial regulators in October of last year, urging further revisions to the rule to address outstanding issues such as the rule's covered funds definition and its broad application to venture capital, other long-term investments, and loan creation. In addition, I'm concerned that the proposed accounting test may make the Volcker Rule more complex than is necessary. Can you commit to using your significant regulatory discretion provided by statute to promptly address these outstanding issues?
Yes, we received comments on those issues and more, and we thought some of those comments were very well taken, and we're working hard to try to address them, and I assure you we'll do our best to do that.
I appreciate that. Senator Brown.
Thank you. Thank you again for being here, Chairman Powell. Yesterday, your predecessor, Janet Yellen, said she doesn't think President Trump has a grasp of macroeconomic policy. Is she right?
I won't have any comment on that for you, Senator.
All right, guess I'm not surprised. It's troubling that the former Fed chair, the woman that sat in your job and was very good at that job, tells the press point blank that she doesn't think the President of the United States understands the economy. I think the American people continually and more understand that this president, that many Americans, GM workers in Youngstown and Hamtramck, for example, believe he has betrayed workers in this country. That's becoming clearer and clearer. Let me shift to another question. Last week, former Fed Chair Paul Volcker raised concerns that the culture of banking only focuses on the profits of the firm and the pay of the CEO. I share this concern that we should focus on workers. Since 1979, you know these numbers, Mr. Chairman, worker productivity has grown 70%. Compensation for those workers has grown by just 11%. Meanwhile, the top 0.1% saw their earnings grow by 343%. This disparity, as you know, is even worse for women and people of color. So do you think, Mr. Chairman, the Fed's employment mandate is just to ensure that people are employed, or do you think full employment implies a dignity of work? That is, meaning workers earn a salary and benefits that let them fully participate in the 2019 economy in our country?
Our mandate, as you well know, is maximum employment, and we try to take that to heart. And our tool for trying to achieve that is monetary policy. I think, we're at a 50-year low in unemployment. There are many other issues in the country. You've managed some of them, but honestly, to achieve some of the things you're talking about, we need other tools. It's not. The Fed can't affect every social problem, as you well know.
Is that a social problem that fewer and fewer people, even though they're employed, wages are stagnant? Is that just a social problem?
Well, wages, I would say wages do go into our assessment of maximum employment. We do look at wages, and I'm happy to say that wages, while they were very sluggish in the aftermath of the crisis, have now started to move up in a way that's more consistent with past history and with inflation and productivity.
But not even close to productivity. Not even close to gains in productivity for most workers.
So today, I know the chart you're talking about. You're talking about over the longer run. If you look at what wages are now going up a little better than 3%, inflation's right at 2%. Productivity has been running. Sorry, inflation's been at 2%. Productivity's been around 1%. So 3% is about right from that narrow standpoint. Wages have moved up We welcome that. We don't find it troubling from an inflation standpoint at this point. So we do look very carefully at wages as we assess maximum employment, as we assess whether we're meeting our maximum employment goal.
Let me put it in a bit of historical perspective. Will Rogers, during the Great Depression, provided a lesson I think we could learn from today. He said that unlike water, money trickles up, not down. Of the government's response to that economic crisis of the Great Depression, he said, the money was all appropriated to the top in the hopes it would trickle down to the needy. Give it to the people at the bottom. The top will have it before night anyhow, but at least it will have passed through the poor fellow's hands. They saved the big banks, but the little ones went up the flue. This observation is 89 years old. It seems like the Fed still thinks, from your answer and from the behavior of the Fed, the best way to help workers is to shore up big bank profits and hope the prosperity trickles down. Over the last decade, it has been creative in how it accomplishes this. I believe the Fed has the authority and the duty to be creative, to help workers share in the prosperity they create. My staff will follow up with your staff on ways of doing that. One more question. It seems like too big to fail is alive and well. We are seeing a potential merger. We're seeing growth in most of the largest money center banks, 2 regional banks, as you know, SunTrust and BB&T, each with over $200 billion in assets, decided to merge, saying it was too difficult for them to compete with the money center banks' investment in technology. What message does the Fed send to regional and community banks about their future if the Fed eventually approves this merger?
Well, we have a process that we go through in evaluating any merger. It's set forth in great detail in the law and in our guidance. We will go through that process carefully, fairly, and thoroughly, and with a lot of transparency. When we do get an application, we don't actually have an application yet on that matter. We expect to get it sometime in the next few weeks. So we will do all of that. I would just say we haven't prejudged anything, and we're going to do our work on that professionally, carefully, fairly, and transparently.
Okay. Senator Shelby.
Thank you. Chairman Powell, somebody's doing something right. I don't know if it's the president or you or a combination of everything. I think this is the best economy I've seen in my lifetime at this point. Now, the question is, how do we keep it going? How do we keep it going? That's part of your job, not totally, but you're into the money. How do you gauge inflation, for example? You know, there are a lot of ways to do it. That's one. You're talking about price stability, maximum employment. Price stability, you're talking about the stability of the monetary policy, the value of our currency and everything that goes with it. How do we keep this economy going, in your judgment?
So I think you said it very well. We want to use our tools to sustain this expansion and keep the labor market strong and keep inflation near 2%. That's exactly what we're trying to do. And so we look around and what do we see? We see a labor market that is strong and continuing to strengthen. Job creation is strong. Wages are moving up. So that's a very healthy thing. With inflation, we see in muted inflation pressures. Even now with really historically low unemployment and a great recovery, an ongoing recovery in the labor markets, we still see muted inflation pressures. And that gives us the ability to be patient with monetary policy. And that's what we're going to do. The committee has decided that with our policy rate in the range of neutral, with muted inflation pressures and with some of the downside risks that we've talked about, this is a good time to be patient and watch and wait and see how the situation evolves.
How does the abundance of hydrocarbons that we have found in this country in recent years, which is prices everything, how does that feed into the economy in a positive way?
Well, in a couple of ways. One, it's a big industry. We have a very large energy industry now, thanks really to shale. In addition, if you think about so that employs a lot of people, and that's a big thing in certain areas of the country. 5 or 6 major areas of the country have a lot of employment and economic activity. Interesting on inflation, if you look back to the 70s, a lot of what set off the bad inflation outcomes in the 70s was an oil shock. What we have in our very large domestic oil industry now is, in effect, a shock absorber, because when oil prices go up, American oil shale producers and other oil producers will produce more oil. And so that offsets that shock and will prevent that shock from driving inflation up here. So it's been a real positive for our economy from a number of perspectives.
Mr. Chairman, how important is the certainty of good trade agreements to our economy and to the world economy?
Well, uncertainty is the enemy of business.
Absolutely.
And businesses, they want a set of rules, they want an established, transparent set of rules, and they want to play by those rules, be able to make longer-term plans, investments, and hiring, and that kind of thing. At the same time, we need the trade. We're not responsible for trade. We don't comment on trade policy at all. But we've been hearing a lot from our contacts around the country, really all year, this year and all last year, about uncertainty, and we do sense it's been holding back some decisions, probably had some minor effect on confidence and maybe activity. But overall, certainty around trade and other government policies is very important.
As we look at our current account, the imbalance of trade with most of the world, does that concern you, and if it does, why?
The overall current account is set economically by the difference between savings and investment, in our country. So it's really an identity that kind of works that way. It tends to go up in good times when Americans are at work and earning well and buying things, and the economy is strong. We tend to buy things. Some of those things tend to be imported. The trade deficit and the current account balance can go down quickly in bad states of affairs. Of course, over time, we'd like to see balance both in savings and investment and in the trade balance.
I don't have much time left, but we've discussed this before, cost-benefit analysis. Last year, when you came before the committee, we discussed here the formation and the policy effectiveness and assessment unit to conduct cost-benefit analysis on regulations. Could you provide here an update on the work of the entity here, and what have you learned and what's going on?
Yes, so that unit is up and running now, and it's a relatively new undertaking. Cost-benefit analysis is something we've of course done really always, and particularly in the last decade or so, we've upped our game. Now we have a particular unit focused on it. We're very pleased with the progress it's making, and they're involved in the rulemakings and assessment of everything we do. So it's a positive development, and we look forward to making it ever stronger.
My last question to you, is a few seconds I have left, is what's the health of our banking system that you regulate with the Federal Reserve, our biggest banks?
I think our banking system overall is quite strong. Record profits, no bank failures, I think, in 2018. Much higher capital, much higher liquidity, better risk management. The stress tests have really focused banks on understanding and managing their risks. We've got better resolution planning. Overall, I think our banking system is strong and resilient. We never take it for granted. We're always looking for problems and cracks, but I would say overall our banking system is strong.
Thank you. Thank you, Mr. Chairman.
Senator Menendez.
Welcome, Chairman. As the number of legitimate cannabis-related businesses grow across the United States, the vast majority of banks and credit unions are not offering services to these enterprises for legitimate fear of legal and regulatory risk. My home state of New Jersey is moving towards legalization of recreational marijuana, and I have concerns that these new businesses, as well as the existing medical marijuana businesses in the state, will continue to find themselves shut out of the banking system. And when these businesses are forced to operate exclusively in cash, they create serious public safety risks in our communities. Do you agree that financial institutions need clarity on this issue?
I think it would be great to have clarity. Of course, financial institutions and their regulators and supervisors are in a very difficult position here, with marijuana being illegal under federal law and legal under a growing number of state laws. It puts financial institutions in a very difficult place. and puts the supervisors in a difficult place too. It would be nice to have clarity on that supervisory relationship.
And in a corollary question, related to the provision of banking services is the ability for such businesses to secure insurance products, a necessity for those looking to secure financing. Would it be helpful for Congress to also consider the role of insurance companies as states move forward towards legalization?
I believe so, yes.
Okay. On a different question, February 7th, BB&T announced that it planned to purchase SunTrust in a deal that would result in the combined bank becoming the 6th largest commercial bank in the country with $434 billion in total assets. As you may know, in 2008, BB&T's Community Reinvestment Act rating was downgraded due to substantive violations of the Equal Credit Opportunity Act and the Fair Housing Act. BB&T's most recent CRA exam, released last year, also included a substantive violation of fair lending laws, a violation which likely should have resulted in another downgrade to the bank's CRA rating. I want to be sure that the Federal Reserve is not following the OCC and de-emphasizing its treatment of fair lending violations when it comes time to evaluate a proposed merger. What assurance can you give us that the Federal Reserve will treat these violations with the seriousness they deserve?
We haven't changed our policy on that, and we do consider it comes in under in the law under convenience and needs of the community served, and that includes consumer compliance and fair lending records, and the record of performance under CRA. Those are all things that we do consider in when we get a merger application.
And when you're considering it, can you give us a sense of what the Federal Reserve's review of this bank or any other bank's Community Reinvestment Act track record and compliance with fair lending laws will look like?
We'll look, we'll look thoroughly at it. We'll look at the rating, of course, which I believe is, I think it's satisfactory now. Banks that have an unsatisfactory or less than satisfactory rating, I think, have a hard time. But we'll look at that, and we'll also consider public comments and a full range of information. Any information that's presented to us, we'll consider.
Well, I ask this question because it seems to me that, particularly at the OCC, who has released a proposal without input from the Fed or FDIC, contemplating sweeping changes to the implementation of the Community Reinvestment Act. In a speech last year, Governor Brainerd said the Community Reinvestment Act was, quote, more important than ever. She stressed that branches and deposit-taking ATMs remain an important way that banks engage with the community. You also highlighted recently the importance of enforcing the CRA and other laws that help ensure people have adequate access to financial services wherever they live. Can we get your commitment to build consensus among the Fed governors before moving forward with proposals to change implementation of the Community Reinvestment Act?
Oh, yes.
Okay. I think it's important that you do everything in your power to try to achieve a unanimous vote on this issue should the Fed decide to move forward. Many of us find this an incredibly important part of our law and an increasingly diminishing reality of financial institutions that somehow think that they do not really have to fully engage and implement the law and ultimately still get away with it. And so I think there has to be a strong message that that's not the case. I hope you'll be able to deliver that message.
We are unified in our commitment to, to the mission of CRA, and to any revisions that we do, we're going to want to see that they preserve that mission and enable banks to serve it more effectively.
Thank you, Mr. Chairman.
Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, welcome back. Good to see you again. Let me just start by once again complimenting you and your colleagues on taking us a long way towards normalizing monetary policy. In my view, this was long overdue, but you have been pursuing what strikes me as a prudent, thoughtful, and data-informed process of getting back to normal. So I want to thank you for that. Quick regulatory question, if I could. I was pleased with the interagency proposal that was released by the Fed and the other agencies dealing with 2155 and specifically the tailoring of capital and liquidity requirements, enhanced prudential standards. I think the comment period closed in January on this proposal. Can you assure us that it's a high priority to finalize these rules?
It's a very high priority. 2155 implementation is probably our highest priority, and we're pushing ahead.
Any idea of a time frame by which we could expect to see finalized rules there?
I wouldn't want to put a date on. I mean, there's so many rules. There are a dozen rules where we have comments on right now. I can come back to you with
Okay, but I'm glad to hear it's a priority. We're
It is.
obviously eager, and we think I think you're heading in the right direction. Unrelated, as you know, the private sector has set up a real-time payment system, and I think a real-time payment system is a terrific innovation that's very, very good for our economy. My understanding is all depository institutions have access to it on an equal footing, as they should. To the extent that that's the case, do you believe it's necessary for the Fed to develop a alternative or competing real-time payment system?
That's a judgment that we haven't made, that we sought comment on that question, and we've had a range of views, and it's something we're thinking about. We are mindful that we don't, under the Monetary Control Act, for example, we have to find that the services we provide are capable of being paid for, and also not something that the private sector can adequately provide. So
right.
We're looking at that very question.
I'd be interested in just hearing what your thoughts are as you go forward on that. It does seem to me that the private sector is providing a perfectly viable and affordable and reasonable mechanism here. On another topic, as you know, there's been recent discussions, both I think inside and certainly outside the Fed, about whether the Fed ought to reconsider the way it thinks about inflation. And specifically, I guess the way I understand this discussion is whether the Fed ought to target a price level rather than a change in the price level. And specifically, if there were an extended period of time when inflation ran below a target, would it make sense for the Fed to intentionally attempt to exceed the target modestly or by enough so that over a long period of time you'd hit the average? My first reaction is to be pretty concerned about that. Intentionally running at an inflation rate above the target rate worries me, given that historically inflation has been much harder to control, and high inflation has been a bigger problem than low inflation. But I wonder what your thoughts are about this topic.
These are questions, as you know, that are going to be the subject of careful consideration over the course of this year and beyond in our thinking. You know, the issue that we face is that rates have come down, long and short rates have come down really over the last 40 years and are now they're just much lower. Real rates, right. And of course inflation, add inflation back in, nominal rates as well. The implication of that being that in a typical downturn, the odds are much higher that we'll wind up back at the zero lower bound again. So in that situation, that fact there has the potential to drag inflation expectations down over time. In our thinking, inflation expectations are now the most important driver of actual inflation. So we're trying to think, and really the economics profession has been thinking about it for 20 years, since the experience of Japan in the late 90s, thinking of ways to make that inflation 2% target credible, highly credible, so that inflation kind of averages around 2% rather than only averaging 2% in good times and then averaging way less than that in bad times, which would drag expectations down. No decisions have been made. There are plenty of questions and concerns to be addressed, but there's also a problem that I think we owe it to the public to try to think our way through the best possible way to address that problem so that we can carry out our mandate.
Yeah, I understand the logic. I understand the problem that you're wrestling with. I would just urge great caution on this for many, many reasons, not the least of which, for whatever period of time the Fed decided it would exceed the goal so that it averages the goal. First of all, during that period of time, presumably you don't have price stability. I mean, certainly not zero. I mean, you'd be intentionally running above even the goal. So I've got other questions, but I see I'm out of time. I just want to urge caution on that one, Mr. Chairman.
Senator Tester.
Thank you, Mr. Chairman. Ranking Member Brown, thank you for being here. Chairman Powell, I appreciate your service, appreciate the work you're doing. I want to talk a little bit about The government shutdown that we just came through cost the economy $11 billion. I think that's a conservative figure. There's at least one in this government that wants to use government services and public employees as a pawn when they don't get their way. But what I want to ask you about is that we are faced with a debt ceiling coming up March 1. Could you walk us through quickly, if you could, the economic impacts of failing to increase that debt ceiling?
Well, the failure to increase the debt ceiling creates a lot of uncertainty in the first instance, and then when you actually get up to the point where the government runs out of cash and doesn't pay its bill, we've never passed that point yet. That's kind of a bright line, and I hope we never do pass it. But there's a lot of uncertainty that's generated and a lot of distraction from what is otherwise a pretty good economy.
What would happen to our interest rates on $22 trillion worth of debt if we were not to do what we needed to do with the debt ceiling?
It's beyond even considering. The idea that the United States would not honor all of its obligations and pay them when due is just something that can't even be
Would it double?
considered. It would go up. I mean, I think we have the best credit rating. We borrow at very low rates, and the world believes in our full faith and credit. And I think that's not something I would.
It would have draconian effects on our economy overall.
Potentially, very hard to predict and possibly large.
But there's some
effects.
there's some that in this body, quite frankly, that say it'd be no big deal. Do you agree with that?
No, I don't. I think it'd be a very big deal to not to pay all of our bills when and as due. I think that's something the U.S. government should always do.
I agree. Senator Shelby talked about the certainty of trade agreements. I won't ask you to grade this administration's trade policies, but from your perspective, how is this administration's trade policy affecting our economy? Positively or negatively?
You know, we don't play a role in trade negotiations. I think it'd be inappropriate for me to comment on their trade policy, either directly or indirectly. As I mentioned, you know, we've been hearing, and everyone's been hearing from business about it, and particularly I would think in your state, hearing about trade.
Exactly. And in my real job, I farm. And I can tell you, as we prepare for planting this spring, I can't tell you any commodity or any livestock that's going to make us much money, if any. And so I believe the Minneapolis Fed came out and said that bad egg loans were seeing an uptick, a serious uptick, I might add, in farm foreclosures. Are you concerned about that? Do you think it is a direct result of trade, or is it something else?
I actually did see that piece. It's as you know far better than I. The agricultural economy has been under a lot of pressure for really 5 years now. It's just low crop prices. Sustained low crop prices, and that hasn't changed, and that has driven up, you know, bankruptcies under Chapter 12, foreclosures, and all kinds of bad things. So, I mean, I think the bigger picture is just crop prices have been low, and obviously the trade issues haven't helped this year.
Okay, and the Federal Reserve also suggests that farm bankruptcies haven't peaked yet, that we haven't seen the potential negative impact on rural America that these low commodity prices, and might I add, before that 5 years, we had some of the best ever when we had some trade going on. Do you agree with the assessment that the Federal Reserve study suggests that we haven't seen the peak of farm bankruptcies yet?
I did read that, whatever it was, an article or a blog post, and it did say that. I mean, it sounded plausible to me. Okay.
We in agriculture got a bailout. It was pretty serious dollars overall, but it didn't amount to much by the time it got to the ground. Truthfully, as compared to what production ag is losing in products. But we also hear from more than just agriculture. We hear from small businesses, and the small businesses are telling me that the big guys can afford to stay in business because of these trade wars, but they're going to be out of business. And we're not talking about family farms now, which is absolutely affecting my previous question. But do you believe that the trade policies impact smaller businesses greater than the big ones?
I don't know the answer to that. It's a fair question.
Okay. Well, I've got some other questions we'll put in for the record, but I want to thank you for being here today. I will tell you that the economy is booming, but there are a lot of flags that are coming up that I'm seeing that are canaries in the coal mine, so to speak. And I hope you're a smart guy. Hopefully you're able to pay attention to those to avoid any pitfalls. Thank you.
Senator Rounds.
Thank you, Mr. Chairman. Good morning, Chairman Powell. It's good to see you once again, and thank you very much for coming in today. Before I begin my questions, I wanted to take a moment to underscore the importance of the Insurance Policy Advisory Committee that the Fed is required to establish pursuant to S. 2155. As you're aware, South Dakotans have a very strong interest in preserving our state-based insurance regulatory system. I look forward to working with you and the new committee to find ways that we can promote the interests of our state-based system. So appreciate that. I've got a series of questions that I think I'm just going to put them in as questions for the record and ask you to respond later on. Very seldom do we get an opportunity to have the chairman of the Fed come in front of literally the country and to share his thoughts about the direction of our country, in many cases, the financial systems that we have here and so forth. And I got to thinking this is probably an opportunity that we shouldn't let go by to talk about the impact of the federal government and its spending with regard to monetary policy as well. And in particular, it seems that Congress has a tendency to only make changes in the way it does business when there is a crisis at hand. And I'd like to give you an opportunity to perhaps visit with us and offer, if not direction, at least an observation as to what happens when Congress fails to take care of some of the safety net programs that we have in this country. And I'm going to begin by simply recognizing that we have $22 trillion in debt. And clearly that debt is being financed. That means there's competition for those dollars. The Federal Reserve, on the other hand, it actually manages through regular meetings and discussions, and the quantitative easing is an example of one where you as an organization have very carefully selected how you will work that through, how you will refinance and so forth, but you manage it on a regular basis. Congress has a tendency with its budget and the money that it spends to not even look at a number of the expenditures. Today with our budget, we have about 31% of the budget that we actually vote on. We vote on defense and non-defense discretionary spending. We don't vote on, and nor do we appear to manage Social Security, Medicare, Medicaid, or interest on the debt. About 70, well, close to 70% of all of that which we spend every single year. Every single year, for as far as we can see, we're going to run significant deficits. Would you care to comment on the way that Congress manages or does not manage the safety nets, Social Security, Medicare and Medicaid, and what the impact that has on our economy as a nation?
I should start by saying that we try to stay in our lane, which is monetary policy, bank regulation, financial stability, and not, we have no supervisory role or really role as a commentator. We don't score bills. There's JCT, there's CBO, there's OMB, and we don't do those jobs. But I will say that, and as I said in my statement, that the U.S. federal government is on an unsustainable fiscal path, by which is meant that that debt as a percentage of GDP is growing, and now growing sharply, growing quickly, faster, and that is unsustainable by definition. We need to stabilize debt to GDP. The timing of doing that, the ways of doing it, through revenue, through spending, all of those things are not for the Fed to decide.
But as perhaps, for lack of a better term, one of the chief economists in the nation, to be able to give advice to the folks that are out there, to the country as a whole, about the things that we have in our future and about the threats to our future, Social Security will go bankrupt unless we start managing it. Is that a fair statement?
Well,
on the current trajectory?
I think, if I could say it this way, I think what happens over time is that we wind up spending more and more of our precious revenues to service the debt, to pay interest to people who own the debt, as opposed to investing in the things that we really need, education, all the things that we need to be investing so that we can compete in the global economy. I think if I had, on the spending side, the thing in my personal thinking, again, this is not the Fed's role, but and I think in many people's thinking, the thing that drives our fiscal unsustainability, the single biggest thing, is just healthcare delivery. We deliver healthcare outcomes that are pretty average for a well-off country, but we spend 17% of GDP doing it. Everyone else spends, on average, 10% of GDP. That's $1 trillion plus, way more than $1 trillion every year that we spend in delivering healthcare. So if I were in your seats, and I'm not, then I think that's a good place to look. It's not that benefits themselves are too generous. It's that we deliver them in highly inefficient ways, particularly healthcare.
If I could, and I know I'm out of time, but I'll just say, in other words, what you're saying is if we actually managed the resources that we had, we could probably do a better job than what we do today, where we just simply don't even include it in our regular budget that we vote on a year-to-year basis.
Again, I'm not here to criticize Congress, but I do think it's a profitable thing to do.
Thank you. Thank you, Mr. Chairman.
Thank you. I'll agree with you, Senator Ernst. Senator Smith.
Thank you, and it's wonderful to see you again. I appreciated very much our conversation in my office the other day, and I want to follow up a little bit on what Senator Tester was asking about regarding the economic issues in rural areas. So, and I appreciate your interest in this discussion, and it was this was featured in the monetary policy report that you put out. And, it strikes me that if you look at the overall positive numbers in our economy, it's a good thing, but when you unbundle those strong numbers, you see inequities and gaps, as you pointed out, around race and gender, and then also around rural areas. And in Minnesota, it's interesting. We have some rural counties where the unemployment rate is close to 2%. And then we have other rural counties where the unemployment rate is more like 6 or 7%. So your monetary policy report highlights, the impact, what's happening with rural workers without a college degree in particular, and the impact on labor force participation and how employment to population ratios have recovered dramatically for college-educated people, but less so for non-college people. And I'm really worried about this disparity that it is causing. So can you tell us, in your judgment, why is this gap widening in rural areas?
So I thought that box is very interesting, and you'll note that like so many economic problems, there's no really clear or easy answer. But the way I would say it is, the gap between rural and urban areas in unemployment is not so big. It really shows up in labor force participation.
Right.
So that's where it shows up. So when we think about low labor force participation, the first thing that comes to mind is educational levels, because people in the population, the broader population, lower educational levels tend to be associated with lower labor force participation. But even accounting for that doesn't account for much, really, of the disparity. So, it can be that rural areas are more associated with manufacturing activities, which have had less recovery than the service sector, which is now much larger than the manufacturing sector. In addition, it all may be affected by people leaving rural areas. So, in other words, people who leave rural areas to go to an urban area and where there are better job opportunities. So it's something to that we're still working on understanding, but it's a fairly stark disparity, and I think we all see it.
Right.
I was in Mississippi a couple of weeks ago and certainly saw it there in rural area.
So when people are leaving, does that suggest then that the population that is left is older and
or perhaps less able to find a job, less able to take part in the labor force. So some of the people who have job skills may have left that area, leaving the remaining population with a lower labor force participation. That may be part of it.
So would that not suggest that it would be smart on our part, for this is not a Fed policy, but it is a policy to increase our emphasis and our investment in career and technical education, the kind of training that you need in order to fill those manufacturing jobs in rural areas?
So I do think that we could use a national focus on labor force participation, and that would be certainly one piece of it. It's really, we don't really have the tools. I can identify it as a problem, and it is a serious problem, but I think that's a profitable place to look.
Yeah. The other thing I wonder is maybe people are not coming back into the workforce because they can't afford to. In rural Minnesota, you can't afford childcare and it's not readily available. You are, so the work, maybe part is, I wonder if isn't part of the problem that the jobs that are there aren't paying. So how come wages don't go up? If there's a demand for labor, people potentially are there. Why don't wages go up?
So I think, as I mentioned earlier, wages have moved up from their very low levels of increase earlier. I wouldn't say that they're going up quickly now, but they're going up at a more healthy rate. There are some things in the federal tax code where people lose their benefits with their first dollar of earnings, which, again, it's not our job, but that doesn't sound like you want people to go back to work.
That's counterproductive.
You want them to be rewarded for going back to work, and it seems like that's something we could look at.
Right.
You could look at.
Thank you very much, Chairman Powell. I know I'm out of time. I want to just note that I appreciated the question that Senator Tester was asking about farm bankruptcies, which is a real concern in Minnesota and across the whole northern swath of states. And I'm going to follow up with a written question about how you see those farm bankruptcies potentially affecting the overall economic strength of the country, especially in rural areas.
Great.
Thank you, Mr. Chair.
Senator McSally.
Thank you, Mr. Chairman. Chairman Powell, good to see you again. I want to continue actually on the line of discussion that you've been on. In our conversation when we met, we talked about this labor force participation issue. And everywhere I go in Arizona, in the more metropolitan areas anyway, the economy is doing great, the optimism is there, but they are lacking for workers. They are just screaming for workers, and it's really up and down the skill set. It's not just in the trade craft, although that often tends to be those areas. And so what we're seeing is labor force participation rate is going up a little bit, ticking up, but there's clearly still this gap that is maybe holding back even more economic growth because of the mismatch of not having the workers for the jobs that are there. So can you just give some additional perspective on that, and what within your power and within our power do you think that we can do in order to incentivize increasing that number, get more people off the sidelines, get them the skills that they need in order to continue to provide more opportunities for people we represent?
Sure. So this strong labor market and strong economy that we have at the aggregate level is, as you mentioned, is pulling people back into the labor force or encouraging them to stay in the labor force and not leave. So this is very, very positive for us. And labor force participation has gone back up above 63%. And that to be in the labor force, by the way, you've either got to have a job or have looked for a job in the last 4 weeks. So if you haven't looked for a job in the last 4 weeks and you're not employed, you're not considered unemployed. Right. So this is very, very positive, and we hope it's sustained. But and that's sort of a strong labor market pulling people back in. Even with that, though, our labor force participation rates are lower than other countries that have anything like our level of wealth and income and economic activity. And it's not easy to say why, but I do think, and I think that the Fed's ability to, our ability to address this is really just a function of trying to keep us at maximum employment. There are plenty of people, and it's younger people, particularly younger men, particularly less well-educated younger men, but also people across the gender spectrum and the income spectrum and age spectrum. We just have low labor force participation, and I think we want the economy to grow, and we want that prosperity to be widely spread. Labor force participation gets both of those things almost better than anything. And so I think it's something that ought to be a high focus for people who have different tools than ours.
I agree with you, and not necessarily within your tools, but just based on your perspective. What do you think is holding that back? Like, what's your perspective, and what else can we do in order to remove those barriers for people to, get back in the labor force, to be working to support their families themselves and meet their full potential?
Part of it would be probably education and skills gaps. Part of it would be the opioid crisis. And there just would be a range of things. And I would think that there are also, as we were discussing a minute ago, there also are some disincentives to go to work that are built into benefit programs. I met with a group of women in West Virginia last year who were in an apprenticeship program for carpentry, electrician, plumbing, steel work, and that kind of thing. And the hardest thing they had to do was to go to work in this program, which had 100% placement and which paid, $9 or $10 an hour, because that was less than the very meager benefits they were already getting. So they had to take a pay cut to go back to work, and they did it anyway. They did it anyway, which was pretty inspiring. But I think we ought to have policies that reward and support labor force participation. Again, they're not ours. I shouldn't get into the prescriptive business, but I think it's really important for the country.
Thank you. And I do want to follow up on the rural-urban gap. We've got a lot of rural counties. I visited many of them this week in Arizona, and we're seeing the same thing, where there is that disconnect in wage growth and in labor force participation in those rural areas. Do you take that into account in Fed policy? And again, other perspectives of what else we might be able to do on our side or on your side in order to not have that gap widening for those in the rural areas?
So we do in the general sense that we're learning, and we have learned this year that there's more slack in the labor market because people are coming back in. If people weren't coming back in, then the unemployment rate would be substantially lower, but they are, or they're staying in. So labor force participation is rising in either case, and that tells us that there is more room to grow, and that certainly has implications for monetary policy. In terms of urban and rural, we look at that. We look at those disparities. We look at all different kinds of disparities. In a general way, they inform our thinking about the state of the economy, and particularly maximum employment, which is not, there's no one number that you can look at. You have to look at a range of indicators, and that would be one of them.
Okay, great. Thank you.
Senator Jones.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here today. Really appreciate it. I want to stay on the urban versus rural divide a little bit. Obviously, we see you've got senators on this committee who have a lot of urban areas, and it seems like that there's one factor that may come into play that's not quite so obvious that we've talked about, and that's health care. In 2017, the Atlanta Fed set out to study the urban-rural divide in the Southeast, and one of the factors they kept noticing was the impact on residents' health on the economic output. To simplify what is obviously a very complex issue, according to that Fed study in Atlanta, while the portion of workers who say they're too sick or disabled to work is roughly 6% nationally, that rises to over 12% and higher in the rural South. So from your perspective, what role do you think that health outcomes play in economic growth, particularly in rural America?
I think poor health outcomes are very much associated with with a lot of social issues, including low labor force participation and lots of other economic issues, low lifetime earnings, and many different things, and those are obviously more prevalent now in rural areas, as you pointed out.
And I would assume you would agree that if health care is not accessible in those areas, I mean, for instance, in Alabama, we've seen rural hospitals closing left and right, 7 or 8 in the last 7 or 8 years. With the absence of health care, it may contribute to the people leaving those rural areas into urban areas. Would you agree with that? Yeah,
it's hard to say whether the people have been leaving for some time. Some of these counties, as you obviously know, have lost half their population in the last 4 or 5 decades.
If states individually, if the states were to develop policies that would expand health care in these communities, give affordable health care, access to health care, what would you expect the economic impact to be?
Well, I think people who health care is going to, in principle, would allow people to remain in the labor market, would get them back in the labor market, and keep them from getting sick and being out of the labor market. So that would be a positive for the economy.
I appreciate that. I promise you we were not going to ask you to testify in front of the Health Committee. Senator Tester made a comment as he was finishing up that despite, and there is a lot of good economic news. Everybody agrees there's a lot of great economic news out there. But I think a lot of folks also, as in Senator Tester's words, see canaries in the coal mine. Do you see any? Other than the obvious of the debt that we have, do you see any canaries in the coal mine that we need to be looking for in this Congress?
I would say that the outlook for the U.S. economy is a is a positive one, is a favorable one. There are always risks, and right now I would say that the predominant risks to our economy are slowing global growth, as I mentioned, particularly China and Europe. We've seen a significant slowing in growth really over the course of the past year, and it seems to be ongoing. And that can create a headwind for the United States economy. I talked about Brexit. That's an event risk which could have implications for us.
Right.
Here domestically, again, I think the outlook is generally favorable one.
Okay, thank you, Mr. Chairman. And on, Senator Shelby asked you about the state of health of our big banks, which you gave a pretty favorable report on. But in December of this year, right as the government was shutting down, the Secretary of the Treasury issued a press release, and he had a call with all of the big banks to discuss their liquidity and to make sure that things were okay. The next day, I think he had a call with you and some of the other regulators, and that it sent some alarm bells, I think, throughout the country and folks up here. Can you kind of walk through those 2 days and what was the purpose? What did you see was the purpose of the Secretary of the Treasury 4 days into the shutdown, attempting to reassure folks, I guess, that the banking system was okay?
Let me say, I of course would not comment on the Secretary at all, but you know, our financial system, as I mentioned earlier, is very strong. Record profits, no bank failures last year. Capital is much higher, liquidity is much higher, risk management's much better. We don't, you know, we never take this for granted. We keep watching carefully and looking for problems. But I can say that what I was thinking in those days was, you know, we had significant volatility in the markets, and I was just wondering, asking the question, does that have any broader implications for the economy or for the financial system? And the answer I felt was no, but it's something that you are part of the job is to ask that question.
All right.
Which I was.
Thank you, Mr. Chairman. Appreciate you being here. Thank you, Mr. Chairman.
Senator Kennedy.
Mr. Chairman, thanks for coming today. My good friend Senator Brown lamented the fact that our financial institutions are making profits now. That's a good thing, right?
We need a profitable financial system to have a well-capitalized financial system.
Well, is it better if banks are making money or losing money from a macroeconomic standpoint?
I think we want banks to be profitable and strong and well-capitalized, and they have been.
Okay. I want to talk about the government shutdown. Tell me if I get this wrong. CBO estimates $11 billion impact to our economy. We'll recover about $8 billion, so the net loss to our economy is $3 billion. Does that sound about right?
All I know about that is that's what I've read.
Okay, that's what I've read too. Got to trust somebody. I'll take CBO at their word. We've got about a $21 trillion economy. Is that right?
Sounds about right.
Okay. So as a percentage of our economy, that $3 billion loss is 1.5% of 1%. Is that about right?
You did that math very quickly, Senator.
No,
I believe you. I'm going to trust you on that.
Good. Okay, that's an infinitesimal impact, is it not?
That's very small.
Okay. Let's talk about the economy. Since some economists said that if we pass the Tax Cuts and Jobs Act, that our economy would overheat. Those economists were wrong, were they not?
The economy did not overheat, has not overheated.
We're having growth without inflation, is that correct?
We have inflation right at our target.
Right about 2.2%?
Right around 2%, 1.9%.
Okay, and we've had more business investment, is that correct?
We have had solid investment, very solid in the first part of last year, and reasonably good in the second half of this year, and I think the outlook is for continued, reasonable levels of business investment.
And wages are up, is that correct?
Yes, they are. As I mentioned, you have wages now. All of our wage measures have moved up to 3% or a little better, which is a very good thing to see.
Well, I want to get your opinion on and I'm not trying to ask you to make policy, but I'm asking you as a Fed chair. What could we have done in hindsight to encourage more business investment in plants and machinery and equipment and software, which would have created more jobs and hopefully increased productivity? Specifically, let me ask you this. There's legislation to prohibit share buybacks. Is that a good thing? I know share buybacks have a positive economic impact, but if you had legislation that cut business taxes but also said you can't use that money to buy back shares, you have to invest it in your company or pay shareholders dividends, what would you think about legislation like that, just from an economic standpoint?
Well, I think it's, first of all, that kind of a decision is really not in our hands.
I know.
It's really for you to make.
I'm asking you as an economist.
So I would say the goal, I guess I would just say the goal of having prosperity be widely shared, I think is one that we all share. I think the thing about when you talk about companies and what they do with their profits and how they allocate capital, in our system we've always left those decisions to the private sector, to private hands.
Right.
And I would want to understand the consequences of changing that, and I would want to look at whether there aren't other ways to achieve the goals that I think we all want, which is to have prosperity be widely shared.
Okay. Are there other ideas you might have to make sure prosperity is more widely shared?
I think it ties to some of the things we've been talking about here. Labor force participation is just a win for the overall economy. The economy will grow faster, and the people who are not taking part tend to be the ones with lower education, who are at the edges of the labor force. So we are underperforming as a nation on this compared to our peer group.
Why?
It's a good question. It is a problem that stands out here compared to other countries. And
is it because we pay people too much not to work, or is it because people don't have the skills, or is it because they don't have access to the jobs? This is my last one, Mr. Chairman.
I think there's a range of perspectives on this, and there are a range there's some wisdom in a lot of different ideas, and I think the best thing to do would be to get some proposals that would have broad support and work on those. I do think quite a bit of it is skills, education, aptitude, and also not having disincentives in the tax code where people lose their benefits, for example, with the first dollar of pay. That seems like a disincentive to work and none of this, by the way, is in the Fed's hands, but since you ask.
You're doing a great job. Thank you.
Thank you, Senator.
Senator Warren.
Child care. Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. Earlier this month, two giant banks, SunTrust and BB&T, announced that they intended to merge. This new too-big-to-fail institution would have about $450 billion in assets and become the sixth largest bank in the United States. Now, as you know, bank acquisitions and mergers don't go through on their own. They have to be approved first by the Fed. So last spring, I wrote you a letter asking for data on the number of merger and acquisition applications received by the Fed and the number that had been approved over the last 10 years. Chairman Powell, when you answered my letter in May of 2018, how many mergers and acquisition applications for the banks had you received since 2006? Do you remember?
No, I don't have the number.
Would 3,819 sound right?
Yes, exactly.
Good. Okay. And do you remember how many of those 3,819 applications you denied?
No, I don't.
Would 0 sound right?
If you say so.
Well, you said so. It's your letter. Chairman Powell, has the board denied any applications since you responded to my letter in May?
I would just, if I can offer a little context.
Let's get this part out, because that's what I'm trying to do, is build some context
I don't believe we
here.
have. I think what happens is that people don't apply or they withdraw their application.
That's exactly what I'm going to talk about. So 0% of the applications for mergers and acquisitions since 2006 have been denied. Now, that doesn't mean that all potential mergers and acquisitions make it through the process. 13% of applications are withdrawn before they get a decision. According to your letter, Chairman Powell, quote, prospective applicants may discuss a proposed transaction with Federal Reserve System staff prior to filing, and applicants will be discouraged from filing applications where it is apparent that the applications would not meet all of the statutory factors required for approval, end quote. So you think that if you think that a proposed merger won't be approved, you discourage the bank from following through. Is that right?
In some cases. I think that would be in cases where it's clear that there's a statutory problem. You know, for example,
okay.
In some
but
cases.
you approve 100% of those that go ahead and apply. So I assume they're getting
unless they're withdrawn. That's
what I said. So you encourage them to withdraw if they're not going to get an approval.
But they can file and then withdraw.
Well, but the point is they withdraw if they're not going to get it because of a conversation you have that's a non-public conversation. So this is a formal process required by regulation. In order to do an approval, people who object to the merger have an opportunity to file a protest. That's how the process is supposed to work. That would include, for example, communities that are worried that local banks may close following a merger or acquisition, employees who are concerned about losing their jobs, state officials that may be concerned about decreasing competition, and so on. So, Chairman Powell, you've explained that consultation with a bank can start before the merger is announced publicly. When is it that the public can actually file protests, before or after the merger is announced?
So I think the process is that we receive an application for a merger, which we have not received yet. I think we expect to receive it, I'm told, sometime next month. And
when will the public have a chance?
Certainly then.
And that's true in all of these, right? The public doesn't get a chance to comment until after the application is already filed. But the application is only filed after the banks have had a chance to have this quiet conversation with the feds. So well, I just want to get this straight. You and the banks get together in the back room and grease the wheels before the merger is announced. And if you're not going to approve the merger, you tell the bank in advance, and then they go figure out something else. If the public wants a chance to weigh in, they have to wait until you've already made a decision. You know, no wonder you approved 100% of the merger applications. Not a single no. Your approval process itself appears to be a rubber stamp, that everything is happening behind closed doors. So the question I have is about the SunTrust and BB&T merger. Is this one just going to be another rubber stamp? You've already made the decision behind closed doors before the public gets a chance to weigh in?
No, not at all. No, we're going to conduct a very fair and open, transparent process. I think our obligations under the statute are clear and they're quite broad. We'll be hearing from groups of all kinds and going through our process carefully and thoroughly.
So it's just that in the last 3,819 merger applications, which were all approved without a single one for which you said no, this time you're going to be listening to comments from the public that might cause you to say no? You know, I just have to say, I'll bet that SunTrust and BB&T looked at that 100% merger success rate and saw what everyone else sees. And that is that the Fed works for big, rich banks that want to get bigger and want to get richer. And then everyone else pays the price for diminished competition, for worse service, for higher prices, for employee layoffs, for the risk that we have yet another too big to fail bank on our hands. And I just think it's time that we put down the rubber stamp and that we really let the public and everyone else weigh in before we create yet another too-big-to-fail bank. Thank you, Mr.
Senator
Chairman.
Cotton.
Thank you, Chairman Powell, for being here. I want to start talking about stress tests for mid-sized banks. Reform legislation that the Congress passed to the Dodd-Frank Act last Congress increased the threshold for stress tests from $10 billion banks to $100 billion banks. Can you tell us why so many of us still hear from banks in that window who are larger than $10 billion but smaller than $100 billion are still hearing from their examiners that they need to undergo such stress tests?
Well, let me say, the new law is that banks between 10 and 100 do not have to, are exempt from the DFAST stress tests.
Yes.
That should be crystal clear. I think you're referring to the guidance,
yes,
which we're in the process of looking at and revising and I would think addressing that issue.
Okay, but to be perfectly clear, banks between $10 billion and $100 billion are not required to undergo Dodd-Frank stress tests.
Correct.
When I was in Afghanistan and Iraq, young soldiers used to complain about the rules of engagement. And if you looked at the rules of engagement that the four-star commanders had issued, they were actually pretty flexible. That had been filtered down in a different way to the front lines, though. Do you think it's possible that your guidance that you just gave gets filtered down to examiners on the front line in a slightly different way?
I think that's something that happens, yes. And I think, you know, we're looking at, there's this guidance that's still outstanding. Some of these banks are still going to want to do stress testing, and we're not going to discourage that. It's actually a good practice. But we're going to be looking at that guidance to make sure that there's no question that banks between 10 and 100 billion in assets are not required by law to do stress tests.
Okay, thank you. Because, you know, these examiners, they hold a lot of power in their hands, obviously, when they're on the front lines and they're in one of these smaller community banks. And when they say something may be voluntary, you know, that is heard by the banker in a different way than they may intend it. Reminds me of my old basketball coach who used to have voluntary shoot-arounds before school and on Sunday afternoons. And it just so happened that the players that reported those voluntary shoot-arounds tended to be the ones that got playing time on Tuesday and Friday night.
We try to communicate, and I think our examiners do a good job, basically. But, you know, we know we need to work hard to make sure that the message gets out clearly, and we find that our people do listen. So we're alert to that.
Thank you. I want to turn now to a different question. I know there's been some talk here about the unemployment rate, which is pretty low, and the labor force participation rate, which is increasing. We'll talk about wages and wage growth. There was some recent data out from the Bureau of Labor Statistics. It was highlighted in a recent Wall Street Journal article that said, despite these factors, that income to employees in the form of pay of benefits continues to decrease. It's down to 52.7% of our gross domestic income. It was as high as 59% in the 1970s and 57% in 2001. By the same token, business income, profits to businesses, whether they're the biggest corporations or small businesses, have gone from 12% to up to 20%. Can you give me your thoughts on why we're seeing more income going into the hands of owners in this country and less into the hands of workers?
Yeah, so that's the labor share of income is what you're talking about. And really, if you look back through history, it zigs and zags, but it generally zigged and zagged at a higher level. And then right around the year 2000, labor share went down sharply for about 10 years, and then broadly speaking has been about flat since then. You know, it goes up and it goes down, but it's basically flat. And the question is why? It's a really good question, and there are a lot of different answers. Honestly, there's no clear, easy answer. As a separate matter, wages are actually growing at a level that makes sense. The problem is the level. It's not the growth rate. The wages are growing, wages and benefits are growing at around 3%, a little better. That's a healthy growth rate in an economy with 1% productivity increase and 2% inflation. The problem is there were 10 years when that didn't happen, from 2000 until 2010. So, you know, it can have to do with a lot of globalization is a big answer there. That was right around the time of China joining the WTO. Some researchers will connect it to that. In any case, we welcome these wage increases for this reason.
Well, I do as well, and I hope that we'll continue to see them and see a little bit more of that growing economic pie going in the hands of our workers. Thanks.
Senator Cortez Masto.
Thank you. Chairman Powell, thank you for being here again. I have concerns about discrimination in lending, so I want to ask you a follow-up question to the record that I submitted last time you were here, and it involves the Federal Reserve's responsibility to enforce the fair lending laws. I asked you how the Fed would improve its oversight of fair lending rules. In your response, you mentioned that Fed examiners evaluate each financial institution for fair lending compliance. So I guess my specific question is, how would examiners evaluate whether a lender might steer consumers to higher price loans? In your written response, you mentioned credit scores, loan-to-value ratios, and lending products, but can you expand on what the examiners would consider to ensure against consumers being steered to high-price loans?
So I think examiners who examine for that, I believe, are trained to look for patterns of that nature.
Specific criteria. Is there anything specific that they look to that you're aware of?
You know, I have a general understanding of this, but I should come back to you with more details.
Okay, and thank you. I appreciate that. And I would also like to know, would examiners, as you come back and answer this question, would examiners consider incentive pay tied to higher price loans as a red flag or a pattern? Would the existence of bonuses for bank staff that provided a loan with higher fees and interest rates be a red flag to these examiners? So if you could expand on that in writing, that would be fantastic. I appreciate that.
Happy to do that.
Thank you. The other issue that is important for me, because it's an issue in Nevada and across the country, is affordable housing. In your response to my submitted questions for the record, I asked you if the rapid rise of housing costs was encouraging your consumer price models to assume a higher threat of inflation than actually existed. Do you think that the Fed's raising interest rates was a factor in rising house costs?
Well, I think that higher interest rates certainly played into higher mortgage rates, and that will have had an effect.
What about the cost of building that apartment or house?
Yeah, I think materials costs and I think what you hear from builders is labor shortages, particularly skilled labor shortages, and you also hear higher materials costs, some of which affected by tariffs, of course. But that's what so you hear them under tremendous cost pressure, and I think that was flowing through into higher prices, and that was making the affordability calculus a little bit more challenging for buyers. At the same time, rates were going up, and I think that altogether, that picture slowed down housing construction in the last year or so. Rates are now down a little bit, about 50 basis points. And so we're seeing starting to see a little bit of a pickup there.
How would you compare the impact of the higher interest rates on construction to that of the higher prices for goods that may be caused by tariffs?
I think that the higher costs, it depends on who, from the standpoint of the consumer, what matters is what does the house cost. I think you'll find that the interest rate has an important is a very important thing from the consumer standpoint, but in setting the price of the house, it's not the interest rates, it's really the cost of materials and labor.
And then you talked about the higher cost of labor. Could that higher cost of labor also be due to curbing immigration and the lack of labor because of that?
It certainly could in construction, particularly in some regions. I know I visited Houston not so long ago, and I think a big part of their construction labor force was from immigration. I think they were feeling shortages there for that reason.
Thank you. Last summer, the Federal Reserve economists noted that high levels of student debt was preventing millennials from buying a home. Other studies have found that millennials faced housing supply constraints, beginning their careers in a poor labor market, and high student loan burdens, which have made it difficult for them to buy a home. What was the response to the Federal Reserve's assertion that student debt prevented at least 400,000 millennials from buying a home?
What was the response? It's just research, and I think there's a growing amount of research that shows that student loans, of course, have been growing very, very fast in the last few years. And
was that the right number, the 400,000? Did you get
I don't know that
was it
number.
Too high, too low? Was that?
I don't know that number. I will tell you it's $1.5 trillion in outstanding student loans, and there's research that shows that that for students who can't discharge can't service their loans or discharge them, that those loans can weigh on them over a long period of time and have real effects on their economic and personal lives over time.
And ability at actual home ownership.
Yes.
Is that correct?
Yes.
Thank you. Thank you, Chairman, for being here.
Thank you.
Thank you, Senator Moran.
Mr. Chairman, thank you very much. Mr. Chairman, thank you very much. Let me start with what I think is a straightforward question, followed by a much more complicated one. 18 of my colleagues, Senate colleagues, joined me in a letter calling on regulators to provide a more significant reduction in the reporting burden of our smallest banks in the first and third calendar quarters as required by Section 205 of 2155. We're looking for a greater difference in those reporting requirements than what has been proposed. According to the current proposal, banks with those smallest assets would save only an average of 71 minutes per quarter. So not a significant change based upon the proposed rules. Can you speak to whether you think our concerns about our smallest banks and their call reports have been addressed?
Senator, as you mentioned, that rule, we put that rule out for comment. We got a lot of comments and got your letter, and we're carefully reviewing those comments. And I think what we're trying to balance is we're trying to find the right balance, and we'll certainly take into account the comments that we get.
Well, I appreciate that. I would want you to do that. But if the end result of 2155 is as modest as this appears to be, we've not achieved our goal. That can't be the congressional intent, at least in this instance, on this topic. So let me reiterate that. Then let me talk about what I think is at least a difficult topic for me to have a conversation with you about just because of its complexity. A key goal of this legislation was to provide qualifying community banks relief from the complexities and burdens of current risk-based capital rules. But we, of course, want to ensure that they maintain a high quality of capital consistent with the current rules. The recent interagency proposal for community bank leverage ratio allows certain banks with less than $10 billion in total assets to elect to use the CBLR instead of the current risk-based capital requirements if the CBLR ratio is above 9%, the current ratio required being 5%. So under the new proposed framework, a bank would be considered less than well capitalized if it fell below 9% and hasn't opted out of the CLBR. That would then trigger certain restrictions and requirements. As currently written, the proposal seems to dangle the incentive of reduced regulatory burden, but with capital requirements 4% higher for our small banks to qualify. Would it not make sense to leave the existing PCA framework unchanged, allowing small banks to maintain well-capitalized status and begin reporting capital ratios under the current risk-based capital rules when CBLR falls below the 9%?
That's another rule that we have out for comment, obviously. And Senator, can I ask, is that a comment that you have?
If we haven't, we can.
Yeah, I would encourage you to do so. We think these are really important tailoring proposals, and they're obviously mandated by 2155, and we want to get them right. So I understand your question, and we'll look carefully at that.
All of the financial institution regulators working well together in implementation of 2155?
I believe so, yes. I think we share the goal of first of all, putting a very high priority on implementing 2155, but also on tailoring. For smaller banks, I think all of us feel that there's a lot we can do without undermining safety and soundness, and we want to find those things and do them.
I appreciate that approach. I've had many conversations with regulators for as long as I've been on this committee and in the Senate, and it is something that is always, and I'm not suggesting this at all about you, but it's always something that is highlighted, certainly when talking to me about its importance. But it's hard to find change that has occurred voluntarily by regulators to make the burdens less on our community banks. And that's why 2155 was so appealing to me, is that we'd failed generally to get regulators to change their behavior, and 2155 seems to me to be the option, the only option that I've seen that actually might force change when it's been so reluctantly to arrive. So I care a lot about that. In regard, in this 15 seconds I have left, I would remind you that agriculture, as you and I visited about last time we talked, is in significant, faces significant challenges. I want to make certain that our community banks, our relationship bankers, don't lose the ability to consider character and history. Remind you that we have generational bankers along with generational farmers whose grandfather bankers have taken care of grandfather farmers, and down through the generations that's continued. And our community bankers know who has character, who has ability to pay, who has the history to demonstrate that, and we can't tie their strings, or the agricultural challenges the economy faces today, ag country's problems, will be significantly exacerbated if you take away the ability to take into account those factors that are not crossing a T and dotting an I. Thank you.
Thank you.
Senator Van Hollen.
Thank you, Mr. Chairman. And Chairman Powell, thank you for your service. I want to focus for a moment on the impact of the tax bill, big tax bill that passed about a year ago, and especially taking a look at the banking industry, because I think in no other sector is it clear as to what a huge giveaway this tax cut was to big financial interests. I don't know if you saw the Bloomberg analysis that was conducted earlier this month. They looked at the 23 U.S. banks that the Federal Reserve says are most important to our economy, and concluded that those 23 banks got a $21 billion tax break windfall. Did you see that analysis?
I don't know that I did.
And would you be surprised to learn that they used much of that windfall for a major stock buyback?
I honestly don't know. I mean, first of all, I know that the tax cut reduced taxes for big companies that were very profitable quite substantially.
Well, they did, and again, it was $21 billion windfall, and a lot of it was used for stock buybacks that helped a lot of the executives. What's interesting is during that same period of time, we saw a loss of 4,300 jobs among those 23 banks. Does that surprise you? Big tax break, and yet a loss of jobs among the big banks?
It must be several million people we're talking about, so it's a...
Yeah, but of course it was sold on the promise that we would see all these new jobs generated. I do want to ask you about the increase in wages. Obviously, it's always good to see an increase in wages. Of course, nominal wages are only half the equation, right? You also have to look at rising costs when you look at real wages. And isn't it the case that when you look at real wages and the rise in real wages during the last term of the Obama administration, real wages rose faster during that period of time than they have since the beginning of the Trump administration, even with the tax cut? Isn't that the case?
I just don't look at it in terms of those time frames. I can't, I would say that the way I would say it about wages, if you look back to 2012, if you look at the four major wage and benefit increases, things that we track, it was around 2%. All of them were right around 2%. Now they're at 3% or a little better. And part of that is just that the labor market has continued to improve since that time.
Sure, no, of course. But as you testified, you've also seen an uptick in inflation and costs, right? And so the result for a real American, right, is how much of the increased wages that are coming in, what the purchasing power of that will be. Anyway, if you could take a look at that and get back and confirm whether or not that's true. The figures I've got suggest that you saw a more rapid increase in real wages, again, during the last term of the Obama administration, which just gets to the point about, there's a lot of hype about the tax cuts. Let me ask you about student loans. My colleague just asked you about that. You just testified that we've got $1.5 trillion in student loans. I think that the Fed just reported that delinquent U.S. student loans reached a record $166 billion in the fourth quarter of 2018. You indicated this is putting a lot of stress on students who are, trying to get out there and buy their apartments or rent their apartments. Would you be in favor of allowing students to discharge their debts in bankruptcy just like banks can?
So I think it's important that students be in a position to borrow, to invest in their education. It's important that they get proper disclosure about what the risks are and what the success rates are and that kind of thing. It's not a Fed. Someone asked me at this committee a year or so ago that question, and I did answer it directly. But I would say it's not really for the Fed to decide.
Let me ask you
this:
is the impact of student debt, in your view, impacting the economy in a negative way? The fact that these students are, stuck as soon as they graduate, trying to pay back loans that they apparently can't repay.
Yes, I think for students who can't repay their loans, and there's a growing amount of research that shows that those people can have, longer-term negative economic effects. Of course, some people invest in their education and borrow money to do it, and it works out very well for them as well. But for those who don't, it can be quite a negative.
Well, it's a lot of people who can't right now. I mean,
that's right.
You just reported a record delinquency rate in the last quarter. The last thing I would say, Mr. Chairman, while I have the Chairman of the Federal Reserve here, is I'm going to keep after you and your colleagues on this faster payments issue. It makes no sense to me that Mexico, South Africa, soon the entire European Union will have immediate, ability to clear payments while we don't. Cash checked on Friday won't clear to the middle of next week, and millions of Americans are paying a lot more in terms of late fees and payday loan interest rates at sort of loan shark rates because of that. So I hope you'll give the same attention to that issue as you're giving to some of the other issues you discussed this morning. Thank you.
We will.
Senator Perdue.
Thank you, Mr. Chairman, and thank you, Chairman, for being here and for your perseverance. These are big committees. You've been here a long time. I have two questions for you. One is I am always amazed at the economic experts in this committee and the revisionist views of history. So let me just throw some facts out and leading to a question for you. This recovery is real. We're growing about 100 basis points more than the last administration just after 2 years. CBO says if you grow 0.4%, you more than pay for this tax bill. So those are two facts. The second thing is median income is at a historic high. It's the highest ever been in the United States. 5 million new jobs have been created, lowest unemployment in 50 years, lowest African-American unemployment ever measured, lowest Hispanic unemployment ever measured. My concern, though, is with labor issues, with export issues, and interest rate issues. We've had 9 Fed fund increases over the last 2 years or so, 2.5 years. And with our debt, and this is the question I'm trying to get to, and you know where I'm going here. I appreciate the time you gave me recently in a private conversation. The federal debt really bothers me, and its overhang on the economy and our ability to drive the economic wherewithal of every American. The national debt is the greatest threat to national security, according to our military experts. And yet today, we just turned $22 trillion of national debt on, if you include all the debt that we have as a government. As I understand it, there are about $200 trillion of debt in the world, 60 trillion of that sovereign. We have about a third of that. 5% of the world's population has about a third of all sovereign debt. So the question I have, and the projection is in the next, that increase is 2.25%. With our size debt, technically is about $450 billion in new interest that we've loaded in there. And yet, of that $60 trillion of sovereign debt in the world, about 11 trillion of that is laid out at negative interest rates. Much of that's in the Eurozone. And my question is are there carry-on contagion issues out there that could negatively impact this recovery and the continuation of this recovery independent of what we do fiscally or monetarily here in the U.S. due to these negative interest rates around the world?
I think the negative interest rates that you're seeing are a reflection of kind of a risk-off mood and slower growth in China and Europe in particular. Europe has had a good, strong year in 2017 and then really slowed down over the course of 18, and we're seeing some more of that now. I think so. That's what you're seeing. I think it really is through slower global growth for the United States can be a headwind, just as very strong. 2017 was a year of synchronized strong growth really around the world. It was a very good year, and we were feeling a tailwind from that. That has now turned into a bit of a headwind for us. Our economy, though, I think the outlook for our economy is still a favorable one, still a positive one, but nonetheless, this will be a headwind.
There's a growing debate in Congress now among some of my colleagues about advocating a change in how monetary and fiscal policy work together, and these people are advocating a modern monetary theory. They want to spend now, spend later, spend often policy that would use massive annual deficits to fund these tremendously expensive policy proposals such as Medicare for all, free college for all, make every structure in the U.S. energy efficient in 10 years, and a universal basic income whether you're working or not. Under this landscape, it's proposed the Fed would keep interest rates artificially low and that fiscal policy would then be driven by Congress and would theoretically manage a business cycle. What obstacles do you anticipate in seeing that, and how successful has fiscal policy been in terms of managing either inflation or interest rates?
Let me say, I haven't really seen a carefully worked out, you know, description of what is meant by MMT, was what you're mentioning.
Yes, sir.
It may exist, but I haven't seen it. I have heard some pretty extreme claims attributed to that framework, and I don't know whether that's fair or not. But I will say this. The idea that deficits don't matter for countries that can borrow in their own currency, I think is just wrong. I think U.S. debt is fairly high at a level of GDP, and much more importantly than that, it's growing faster than GDP, fairly significantly faster. We're not even close to primary balance, which means, you know, the deficit before interest payments. So we're going to have to either spend less or raise more revenue. In addition, you know, to the extent people are talking about using the Fed as a sort of, our role is not to provide support for particular policies. It is to, and that's central banks everywhere, it is to try to, you know, achieve maximum employment and stable prices. And so that's really what it is. And I think decisions about spending and controlling spending and paying for it are really for you.
Thank you.
Senator Schatz.
Thank you, Mr. Chairman. Chairman Powell, thank you for your service. Thank you for your stewardship. PG&E, California's largest utility, filed bankruptcy last month, partly as a result of liability costs from climate-related disasters. The damage from 2017 and 2018 wildfires exceeded $30 billion, more than PG&E's assets and insurance coverage combined. Climate risks threaten many sectors of our economy: real estate, agriculture, fisheries, industries with extensive supply chains. They're all at risk. Take coastal real estate as just one example. The U.S. government currently estimates that storms, floods, erosion, rising sea level now threaten approximately $1 trillion in national wealth held in coastal real estate. According to Freddie Mac, quote, some of the varied impacts of climate change may not be insurable. More than 300,000 coastal homes are at risk of chronic inundation by 2045, a time frame that falls well within the time frame of the 30-year mortgage. These properties are worth about $117 billion and contribute nearly $1.5 billion towards the property tax base. Banks, insurance companies, other financial institutions are all exposed to these risks. And that's why the Bank of England recently announced that it is planning to include the impact of climate change in its bank stress test next year. So here's a simple question. It's not a gotcha question. Do you agree that climate change creates financial risks for the individual financial institutions and for our financial system as a whole?
So let me say, we don't formally or directly include climate change in our supervision, but we do actually require financial institutions, particularly those who are more exposed to natural disasters and that kind of thing, we do require them to understand and manage that particular operating risk. So, for example, if you're a bank in, you know, on the southern coast of Florida and you're subject to hurricanes, we definitely require you to have plans and risk management things in place to deal with that sorts of things. So you would pick up natural disasters and that kind of thing which are associated with climate change.
Do you think your processes and your staff and your sort of approach to this, which has been built properly over many, many years and pursuant to the statute, do you think you're moving fast enough to acknowledge the accelerating risks of climate change as it over the last 2 or 3 years? Do you think there's room for you to do a scrub of whether or not you're fulfilling your statutory mandate? Because I get that you're supposed to pick up any risks related to natural disasters. The question is whether you've really loaded in the latest information from the scientific community to go back to these banks, to go back to REITs, to go back to lenders who have either stranded assets or assets in the coastal area, or whose supply chain is particularly dependent on a certain kind of weather pattern which is not materializing anymore. Do you think you're doing enough in this space? Or let me phrase it another way. Are you confident that you're doing enough in this space?
You know, it's a little bit like cyber risk. You know, should you ever be confident that you're doing enough in that space? So I think I think we're open, we're clear-eyed about the nature of coastal risks and natural disaster risks and that kind of thing. But it's a fair question, and we'll go back and look at it again.
Could you please respond in writing as it relates to this specific question? The Bank of England and 29 central banks and bank supervisors from around the world are moving towards incorporating climate risk into their supervision of financial institutions. You know that another part of the Federal Reserve's mandate is to engage with its counterparts abroad to address systemic risks. Do you think the Federal Reserve should be engaging with its international counterparts on this question?
So we are in those meetings. We're involved in those bodies. We don't, as I mentioned, we don't formally take climate change into account in our risks, but I think that the consequences are things that we do supervise for.
I just think that you've been extraordinary in terms of your ability to withstand political pressure and look at the data and do what's right for the health of the economy. I don't want this to be an exception. I understand that talking about climate change is fraught with partisan peril and will attract the ire of a certain category of people and institutions. But your job is to measure risk, and I would submit that you're not measuring that risk sufficiently. One final question, if you'll indulge me, Chairman Crapo, and that is, has anybody either directly or indirectly communicated with you about rates from the White House?
It's kind of a broad question.
It is a broad question.
I don't really talk about. It's probably not appropriate to discuss my private conversations with other government officials, any other government officials. I would say I'm completely committed to conducting monetary policy in a way that's non-political, in a way that serves all of the American public. And I'm very comfortable and confident that that's exactly what the Fed's going to do.
Thank you.
Senator Reid.
Mr. Chairman, thank you for your distinguished service. Senator Brown brought up in his comments your February 6th town hall, where you made it clear that we have to work to make prosperity more dispersed throughout the society. You also indicated that many of the policies are beyond the purview of the Federal Reserve, but most of them are clearly in the purview of Congress. So if you could just give us one or two, your top three issues that we have to deal with or can deal with to make equality much more realized in this country.
Senator, I'll go back again to labor force participation, which is just it's a big win for the overall economy, and it's also the people who are not taking part in the labor force are by and large the less well-educated and less skilled, or people who may be in areas where opioids are prevalent and that kind of thing. So I think a bipartisan focus, a focus on labor force participation would bring in a lot of policies that would help deal with, what I see as the problems, which are, sort of relatively stagnant growth in incomes, in median incomes, and also relatively low mobility. Education, of course, would be at the top of every list, I think, in addressing these issues as well.
And this would require resources that we would have to commit. And I think you're aware we're on the cusp of another debate about sequestration and the share of resources to defense and non-defense. And in fact, we're looking at very draconian numbers in terms of the situation of the BCA, but you would argue that we do have an obligation to make a significant investment in domestic programs in order to provide for this equality?
I think that it would be great for our country and for our economy if we could address these issues. Of course, easy for me to say. I don't have to find the resources.
Thank you. Let me just turn to another topic, which is very much involved with the Military Lending Act. As you know, it puts a 36% cap on interest rates to be charged to men and women in the uniform of the United States. The Federal Reserve is one of the independent regulators charged with its enforcement. Unfortunately, what we've seen from the CFPB particularly is a retreat. They're no longer supervising this. They're no longer using this in their supervisory activities. They'll enforce a complaint, but the complaints are seldom made. Most young soldiers don't even realize, or sailors, Marines, that they have this ability to complain. We're looking at DOD and OMB exempting an insurance product for auto dealers, which might result in interest payments far in excess of 36%. Can you commit to your continued strong and persistent enforcement to the letter of the Military Lending Act?
Yes, it'll be a priority for us. I commit to that.
Thank you very much. There's another issue, too, that I think you've touched upon, and that is cybersecurity. It seems to be the ubiquitous complaint of everyone, not just in the financial sector, but every sector. And it seems to me, too, that typically those who are going to exploit cyber look for the back door, not the front door. They look for the small institution, not the big Wall Street bank that's spending $200 million a year on cyber protections. How are you dealing with that? How are you and your colleagues dealing with that, going out and making sure that community banks, that other smaller institutions that might be more vulnerable are taking the appropriate steps? Is that part of your inspected procedures? Are you looking closely at cybersecurity?
Yes, we are, and it's hard because, of course, the big banks are attacked too, but they have the resources to deal with it, and so we deal through FIFIAC, you know, which is the body of the regulators, to promulgate guidance. We supervise for that guidance, and with the smaller banks, it's very important, and that is, you know, that is a way that we see that as a real vulnerability for example, for the payment system. But we've also got to be mindful of the burden on smaller banks. But it is something we're very focused on.
Are you focused to the extent of conducting, you know, red on blue exercises, i.e., you know, seeing what's working out there, seeing where all the connectivity exists or doesn't exist? Are you doing that, or getting any access to organizations that are doing that?
We do tabletop exercises, let's say, and these are led by the Treasury Department. This has been a major focus for Treasury, and appropriately so, and we take part in them. There is always the feeling with cyber that you're just not doing enough, right?
Right. Well, in fact, that feeling is justified. No,
probably is.
Unfortunately.
Yeah.
Thank you again for your service, Mr. Chairman. Appreciate it very much.
Thank you, Senator.
Thank you, and I'm not quite done yet, Mr. Chairman. I have a couple more questions. I'd like to go back to the issue of wages that has been discussed by a number of the senators with you. In your testimony and in some of your answers, you indicated that wage growth is at about 3%. And there was some comment by some of the senators, or one of the senators at least, that the nominal wage growth, or that the current rate of wage growth may or may not be keeping up with inflation, if I understand the question you were asked correctly. But if I understand your answers, isn't wage growth today growing at a faster rate than inflation?
Yes, real wages are going up. You have to look at the average over a year or so, and you've got to look at a broad range of indicators. There's no question that wages are going up in real terms by roughly the amount of the productivity increase, which is appropriate. So. And
in your use of the term wages, do you include benefits, or is there a separate calculation on how benefits, employee benefits?
There are four different, there are countless measures of wages, of compensation, let's say. One of them that includes wages and benefits is the Employee Compensation Index, and that might be our single favorite one. It's one of four major ones that we look at. So that one does include benefits, and it too is showing growth in excess of right around 3%, maybe in the low threes now.
All right, thank you. And, excuse me, we've also, in fact, I discussed with you earlier some aspects of the labor force participation rate. And I understand that just the retirement, or the baby boomers retiring, is one of the biggest downward pressures in our labor force participation rate. And I started to have a discussion with you in my earlier questions about now that we've seen that labor force participation rate start to increase, whether that would be stable or not. Could you just discuss a little more with me your evaluation of what it looks like for us in terms of labor force participation in general, and I may follow up on that with a little bit.
Yeah, so I would say it's very gratifying to see U.S. labor force participation actually move up by 0.5 over the course of the last year, as the labor market has gotten just stronger and stronger and stronger. So that's been a great thing to see. Given the level of job creation that we've had, if labor force participation had not gone up, then the unemployment rate would now be much lower than it is. So the unemployment rate's actually gone up to 4% from 3.7%, but this is only a good thing because it means people are coming back into the labor force. The real thing, though, is even with these increases, we still lag other countries. We still lag other countries who have higher labor force participation. You pointed out correctly that the aging of the population is decreasing labor force participation at a trend rate, and that trend rate is about 0.2 or maybe 0.25% every year. So for us just to hold participation flat is actually a gain against a longer run trend. And really for the last, really since 2013, since the end of the latter part of 2013, labor force participation has been flat to slightly up, which again is really good to see. But honestly, that's just a consequence of having a really good labor market. I think if you're going to have that be sustained through good times and bad, and put us on a more competitive footing with other countries, it's going to need more than a good labor market. It's going to need policies that reach out and give people the skills and aptitudes to be able to be sustainably in the labor market.
All right, thank you. I can't remember where I read this, but someone commented recently that today, in the way our labor market is working, that if a person wants to work, there is a job for them. Do you tend to agree with that observation?
Generally speaking, although, if you're in some regions, for example, I mean, there are regions of the country which are very poor and don't have job creation. I mean, I'll tell you where that comes from. The level of job openings is now at or above the level of unemployed people. So that you can say that then, in a sense, if you're looking for a job, there's at least numerically one job. But there are lots of people who are, probably millions of people who are out of the labor force. And in a perfect world, in a better world, would be in the labor force. They're in their prime working years, and they're not in the labor force because of some kind of a problem or issue. And I think those are the people we want to get back.
All right, thank you. And just to switch topics for a minute, we've seen, I think you indicated, a little bit under 3% growth in our GDP in the last year. I guess on Thursday we're going to get some economic analysis that'll give us some statistics on that. One of my colleagues indicated today that with regard to the tax bill that was passed, there was a lot said, and this, I'm not going to ask you to comment on this, I'm just putting some facts out there. There was a lot said about how the tax bill would generate a $1.4 trillion deficit. That projection assumed somewhere in the neighborhood of 1.9 or 2% growth in the economy. It was indicated at the time from all of the analysis we got that if we just had 0.4 of a percentage rate of growth above that, there would not be any deficit involved with the tax legislation. And of course, we've seen far more than 0.4 of a growth so far in terms of the performance of the economy. So that leads to my question, and I know that you don't have a crystal ball, but you do analyze what it looks like for the economy. And my question relates to, given what we've seen a growth of about almost a percentage point in the GDP over the last 12 months, over previous growth rates, if I understand it right. Do you have a projection, or do you have anything that you can share with us about what you see moving forward as to whether the economy will continue to perform? I know you said that it may slow down a little bit this year, but do you have a projection as to what it would likely look like over the next few years in terms of GDP growth?
No, I think you can. I think the good place to start with that question is what makes up growth, and it really boils down to more hours worked, and then more output per hour. That's really all there is. And more hours worked is really a function of population growth. Population growth has slowed, or let's say it this way: the trend growth in the labor force, given aging and given immigration and everything we have, is only about 0.5 right now. And actually, if immigration is going to be even lower, then it's going to be below 0.5. Immigration has made up, half of that 0.5. So that's one piece of it, is 0.5% trend labor force growth. The rest is just productivity. No one can forecast productivity growth with any confidence. All we can really do is create policies that will, encourage investment, encourage innovation, and all those sorts of things, and let productivity happen as it will. It's something that just happens. But if you look at longer-term averages, it's been very difficult to predict. But you'd have to have sustained high productivity. If you're going to have 0.5 labor force growth, you'd have to have, very high sustained productivity, higher than we've seen, frankly, to get, really high levels of growth. But that's why I think it's so important to focus on both of those two things: labor force participation and also productivity. That's the closest in thing we can focus on to raise our potential growth rate.
Thank you. And in terms of increasing labor force participation, I know there are a lot of factors. One that's been brought up here today already is to perhaps change our policy at the policy level so that a person who takes a job who's not currently employed, a person who's willing to go take one of those jobs and become productive in the labor force does not actually economically suffer from that decision based on the safety net program support that the government is already providing. I'm not going to ask you to comment on policy, but is it correct that if we were to eliminate or reduce the incentive to stay unemployed because of the disadvantage of economically of relying on wages rather than benefits, would increase labor force participation?
I mean, I think incentives do matter, and I think I would think if you go back to work, your pay should only go up. In my perfect world thinking, again, easy for me to say, but that's how I would say it.
All right, thank you. Well, switching gears one more time, and then I'll wrap it up. Housing finance reform. As I'm sure you've seen, there's a very significantly increased emphasis on housing finance reform, both on this committee and I think in Congress in general, as well as at the level of the administration. In 2017, you gave a speech in which you outlined a few principles that you saw for how we should approach housing finance reform, and I'm just going to quote what you said. Do whatever we can to make the possibility of future housing bailouts as remote as possible, to change the system to attract large amounts of private capital, and that any guarantee should be explicit and transparent and should apply to securities, not to institutions, and to identify and build upon areas of bipartisan agreement. Do you still agree with those principles and how to approach it?
I sure do.
Well, good. I agree with them too, strongly. And we are going to be very aggressively trying to put together a bipartisan solution to this here on this committee and in Congress in general. And I just would like to ask you, first of all, if you'll commit to work with this committee in our efforts to build the right solution to this issue. And then secondly, any other comments you might want to make about how our nation should approach housing finance reform. And I'd ask you also to discuss how getting this fixed could impact our economy and could impact growth.
Yeah, so I do think, and I said this in those remarks, that I think that this is one of the big unfinished pieces of business. in kind of the post-crisis reform period. Fannie and Freddie had to be taken over by the government fairly early on in the financial crisis. It was a big part of the financial crisis. And I think the proposals that you've had in the past, and I'm sure the one that you'll have this year, I think they all have the right elements there. It's just a question of getting something done. And I think it would be really good for the economy and to get this off the off the federal government's balance sheet and get a lot of private capital between the taxpayer and the housing risk, if you will. So I think it'd be a very positive thing for the economy, and of course we'll be delighted to work with you. We have, I think we have some very strong, experienced staffers in the housing area, and we'd be happy to provide whatever expert help we can.
All right, thank you. And I know I said that was the last one, but this is really the last one. Again, shifting subjects. You've testified today that there are some pretty positive things going on in our economy right now, and that we're in a relatively good position on a lot of factors. In terms of risks to our economy, could you just tell me what you think are some of the bigger risks we should keep in mind?
I do think that the baseline outlook is a good one, favorable one. There are always risks, though, and as I mentioned, I do see the foreign risks as particularly relevant right now. So global growth has slowed. It's slowed in China. It's slowed particularly in the advanced economies, and particularly in Europe. When growth is booming around the world, we feel that as a tailwind. When growth is slowing, we feel it as a headwind. And I think we're feeling some of that now, and we may feel more of it. So that's a risk. Brexit is an event risk, which should not, in the end, have much of an effect on our economy, but it's something we're monitoring very carefully. Domestically, I think we're in good shape. Unemployment is low. Confidence is still at positive levels. So I feel like we have the makings of a good outlook, and as I said, our committee is really monitoring the crosscurrents, we call them, which are really the risks. And for now, we're going to be patient with our policy and allow things to take time to clarify.
All right. Well, thank you. And I know I speak on behalf of the committee. We appreciate the dedication of you and the other governors at the Federal Reserve. We all want to have this economy stay strong and grow stronger. And we look forward to making sure that we can achieve the right policies and help together to make that happen. My last closing comment would be I echo the concerns, or not the concerns really, but the issues raised by some of my colleagues about the implementation of 2155. I know you're working I know you just said it was the highest priority maybe at the Fed right now on the oversight level, but I just encourage you to move ahead expeditiously on those issues. A number have been raised already. I'll reiterate, our concern that we move as quickly as we can on the implementation of the requirements and the principles of 2155 with regard to those financial facilities, banks under $100 billion, and getting the stress testing levels for them at the right point. If you want to comment on that, you're welcome to. If not, I'll wrap up the hearing.
I might add one thing to my last comment, if I could.
Sure.
I would want to leave you with the thought that when I say we're going to be patient, what that really means is that we're in no rush to make a judgment about changes in policy. We're going to be patient. We're going to allow the situation to evolve, and also the balance of risks, and allow the data to come in. And I think we're in a very good place to do that.
All right, thank you. I appreciate that perspective. And once again, thank you for being here with us today. That does conclude the questioning for today's hearing. And for senators who wish to submit questions for the record, those questions are due on March 5th, Tuesday. Chairman Powell, we ask that you respond to those questions as promptly as you can. Once again, thank you for being here, and this hearing is adjourned.
Thank you, Senator.